In this video, I'm going to demonstrate a trading strategy that uses RSI on a 240-minute or a 4-hour chart of pound yen. I've already done videos in the past showing you how to use RSI more for mean reversion type strategies, and I'll link that so that you can have a look at that because I think you'll find those quite interesting too. However, today the strategy on pound yen that I'm going to show you is going to use RSI, but it's going to use it for a trend trading strategy. The rules are really simple as usual. What I'll do, go over, quickly show you how to get in and out of trades using the whiteboard, and then we're going to go over to the charts and see how the trades have worked spanning over 13 years. So we're not just testing over the last 6 months or the last year or the last 25 trades. We're going to get a really good, decent sample size of data and trades. We'll look at the basic rules on the chart, and then we go through some optimizations or some improvements for the strategy along the way, and I'll show you exactly how those work. This is a very average drawing of your RSI indicator or relative strength index. This is somehow what it's going to look when you apply it to your chart. Now, we're looking at a couple of different levels here. We're looking at the 70 level and the 30 level. The indicator actually goes from 0 to 100, but we're interested in putting horizontal lines at our 70 and our 30 level. Now, the RSI comes in different lengths. As a standard, it comes in a 14-period length. We're actually going to look at to see what sort of a length works best for this strategy. So we might look at testing different lengths, but for this strategy, we're going to leave 70 and 30 alone. We're just going to use those kind of default levels and use the strategy as it is. I mentioned this is a trend trading strategy, so what we're looking at is overbought levels, which are up at 70, and oversold levels, which are down at 30. We're looking to buy when the RSI gets into that overbought territory or above 70, and we're looking to get out of the trade, to sell and actually go short when we're going into the oversold levels, which is down at 30. I mentioned it's a 240 or 4-hour chart. So the signal to get in is we want to see a bar, the previous bar with the RSI below 70, and then we're looking for the next bar to be above 70 and close, and that's our signal to go long. And the same here, we're looking for the previous bar to be above 30, and then we're waiting for a close of a bar with the RSI closing below 30, and that's our signal to either exit the long trade and go short, or go short if we're flat on the market. We'll probably use a simple stop loss, just because with algorithmic trading strategies, simple stop losses work best. We'll probably just use a fixed pip stop loss. Could be 100 pips, 150, 200, I don't know. We'll test that out. We'll see which one works the best. Let's go over to the computer, we'll have a look on the charts, how the trades work, and then we'll look at the backtest results to see how this strategy has performed over those past 13 years or so. So here's the first workspace. We've got a chart. It's a 240-minute or 4-hour chart of pound yen. Now you can see down the bottom we've got this RSI indicator. We've got the horizontal green lines. If we look over here, we've got them set at 70 and 30, just like I showed you on the whiteboard. Now you can see, actually, the way that RSI is drawn on this chart, it actually turns red when it goes above 70, and it actually turns cyan when it goes below 30. So that can easily show us where the trades are. So look, as it turns cyan here, you can see we've gone short, and as it turns red here, you can see we've gone long, and turns cyan down here, you can see we've gone short again. Okay. If we zoom in a little bit, in case you can't quite see, we're looking for, let's say this long trade here, we're looking for the RSI to be below 70. You can see it says 66.61, and then it turn and go above 70. We can see it's 72.76. So the minute that happens, the minute that bar closes, on the next open of the bar, we go long, and you can see we've got our buy trade here. And the same for short trades. When it turns from above 30 to below 30, next bar, we take the short trade. Let's just look at the date range on this chart. you can see we've got data here from the 1st of January 2008 until the end of 2018. Now, the reason that I do that, now people do this different ways, this is just the way that I like to do my developing and testing. You'll notice that I've only got data up until the end of 2018. While I'm recording this, it's almost March 2021, so we've got just over another 2 years worth of data that we could actually look at. But what I like to do is like to use an in-sample and an out-of-sample data period. So the in-sample is what we're using here, is from 2008 to the end of 2018. We look at how the strategy works, we might make some changes, might make some modifications and improvements, and then once we're happy with them on that in-sample data, what I then like to do is apply those changes and the new strategy, or the improved, the modified strategy, to the extra data that we've got. In this case, we've got about 26 months, or just over 2 years worth of extra data. That's what we call our out-of-sample data. And hopefully, if we haven't gone wrong and haven't over-optimized things and the strategy is still working, then that's a good sign. It's a bit like instant gratification. It's something that I did when I started developing trading strategies. It gave me instant feedback on whether I was over-optimizing things or curve fitting. So making a strategy look really good on the data that we've got, but if then we actually started trading that in real time, it might just fall apart. By doing this method of using the in-sample to develop and then having that extra, maybe, I normally use at least a year. In this case, it's just over 2 years to show you of out-of-sample data. So we can instantly look, how did that look moving forward on unseen data? And if that works well, then there's a much higher chance, I think, that we haven't curve fitted or over fitted that strategy, and it's more likely to continue and work in the future when we're live trading it. It's just the way I do it. People do it different ways. That's the way I like to do it. It makes sense to me. Let's look at the results then, using this strategy without any modifications. We're using a standard RSI length of 14, and I mentioned we're not going to play around with the oversold and the overbought levels of 30 and 70, but we are going to look at the RSI length. So let's first look, how did this strategy perform? Now, what we can see is the equity curve spanning over those 11 years, and it looks pretty horrible, doesn't it? Now, in this case, normally, if I saw this, I would probably forget about the strategy and decide that using this idea with RSI on this time frame on this market is not working, or I might actually reverse the rules, because this strategy, if you flipped it over, it might look quite good so to reverse the rules. But before I did that, I was just quite curious, because I knew that generally yen pairs do tend to be quite trending, so I just wanted to do a quick check, and it takes a few seconds, on those different RSI lengths just out of interest. So that's what I'm going to show you next. So this is an optimization report testing those different RSI lengths. So the standard one being 14, and we can see on the right hand column here, this is the standard one, which is 14. And if we look at the net profit over here on the left hand side, 14 was actually the only one that didn't work. It was the only one that's showing a negative profit. I tested from 2 through to 14, and if we look at the net profit, the highest is actually at 2, but the average trade value here is a little bit low. Looking at the average trade values, the highest is around about 11. However, we've only got 208 trades here. Now, looking back at the next good average trade, looking at 8, and we've got much more trades. We've got 356 trades. Now, 24,000 yen as an average trade is still a very good average trade, still something that even after costs is tradable, and the net profit of 8.6 million as well, that's not bad either. So I decided to try using an 8-period RSI to see what the results were. Now I have RSI set to 8 periods on this, so let's have a look at the strategy performance report. And straight away we can see that the equity curve is much, much better. Early on, probably right up until about 2014 through to here, it kind of went sideways, but recently has been working very well. In fact, if we looked from about this low point here, we could argue that from October 2010, it was actually working reasonably well. So that was confirmation enough for me to move forward and move into some more developments using this strategy. In the next workspace, what I wanted to look at is the trading times of the day. Obviously, we're looking at a 4-hour chart, so we've got 6 bars per 24-hour session. And are some of those bars less likely to produce decent results than others? So we can actually look at trading in a certain time window. So the first thing I wanted to look at is what happens if we alter the start time of the trade. At the moment we're trading 24 hours, we're going from 0 through till 0 the next day. But what if there were some better options? So in this optimization, you can see I've optimized a thing called start time from 0 through till 2400, which is actually the same as 0. So you'll notice that these results come in clumps of 4. They're going hourly. Well, I've optimized them on an hourly basis, but in fact, because we're looking at a 4-hour bar, these results look the same on each 4-hour period. Now, the ones that worked the best were from 200 through till 500. So these 4 periods here, which of course was the same bar. However, I did notice that between using this start time of 200 and a previous of 0, there really wasn't all that much in it. We got 8.6 million to 9 million, and the average trade 24,000 to 26,000. So I actually decided just to stay at 0. The less inputs that you actually optimize and change, the more likely that the strategy is going to continue to work in the future. And we've got more trades as well. So we've left that at 0. But what about if there was a better ending time for the trade? What about if there was a better than trading right through till midnight the next night? So now you can see the results of the optimization on the end time, and the best results being from this bar here, so 1400 through till 1600. So in terms of net profit, it was almost identical, but slightly better. The average trade is actually slightly less than the previous bars, but like I just said, I like to optimize as least as possible, or narrow things down as least as possible. And trading through to 1600, that kind of makes sense because the Forex sessions start and end at 1700. So we're starting from 0, going through to 1600, or the end of the session. And all we're doing is we're leaving out a couple of bars from the new session through to midnight. So let's see what the results look like using a start time of 0 and an end time of 1600. And straight away we can see that we've got a better equity curve now. These early years are slightly better than what they were before. We've got a decent average trade, as we've seen in the optimization, of 39,000. That's really strong, so that's good. And we're looking at 298 trades. So from here, I'm actually really quite happy with that equity curve. We can try and make it a bit better, but as it goes, for optimizing such little amount of inputs, it's actually really quite nice. But we haven't got a stop loss, so let's have a look at a stop loss next. I've already said that I like using fixed pip stop losses. They just work quite well. So let's have a look. I optimize this from no stop loss at all, which is 0, through to 5. Now that's actually 500, so it's 500 pips we're looking at. Interestingly, on this strategy, the stop loss actually improves performance, which is not always the case. We tend to lose performance a lot of the time, but in this particular case, the stop loss does improve. So using no stop loss, we're looking at 11.7 million, 39,000 average trade. But look how the numbers go up as the stop loss goes up, and we end up with the best numbers around here, and it's a very stable area. We're looking at 50,000 the average trade, And either side of that, we've got some very strong numbers, 15.3 million. So 4.4 is a really good stop loss, or that's 440 pips. Now, this stop loss will probably rarely get hit, but it's just something we need to have in the market to know what our maximum risk will be. Most of the time, we'll actually come out of a long trade into a short trade and vice versa, and not get stopped out at all. So how's that changed the equity curve? And the equity curve is about the same. It's no worse, so that's really good. And I like the way that this was really quite strong recently. We've already seen what the average trade is on the optimization chart. 50,000 yen average trade, 302 trades. Largest losing trade, 440,000 yen, that's our 440 pip stop loss. It is quite a big stop loss, but pound yen does tend to move quite a lot, and like I said, we won't get stopped out very often. Most of the time we'll be into the trade in the other direction. At this point I am pretty happy with what we've done. We haven't done that much in fact, but I'm really quite happy with how the strategy performance report looks. So the next obvious thing to do is to look at the out of sample data. You remember we got unseen data from January 2019 through till the present day, which is February 2021. So we've got just over 2 years worth of data which is out of sample or unseen. So let's have a look at that. But before we do, if you find this video useful and you find these videos help you out, then please hit the like button now, because that helps me out. And if you haven't already, please subscribe to the channel. Now, let's go and have a look at that out of sample data. So if I show you the date range again, you can see that we've got now from January 2019 through till the end of 2021. So we've got that 2 years worth of data. Ignore the fact that that's December 2021. If we look on the chart, we've actually only got up until the 19th of February 2021, because that's as much data as I've got at the moment. So let's look at the performance report. We've only got 62 trades, average trade of 20,000, so that's actually reduced a little bit, so perhaps performance has dropped off. But let's have a look at the equity curve. There's the equity curve. We've got some big dips in the equity curve, but overall, we look at these green dots, we shows new highs. Overall, we are making new highs, so that's quite pleasing. That's really good. And although this 2-year period doesn't look the smoothest curve, let's apply it looking at the whole data range. So let's go back to 2008 through till February 2021. Let's look at the performance report now, and here we can see this very last bit at the top here was what we've just seen, that extra couple of years, and those little dips that didn't look very good on the previous equity graph, now they kind of look in sync with the rest of the years. They don't look bad at all, so I'm not too disappointed with that at all, as all the results that we've just seen were done with no trading costs whatsoever. I know some of you like to see the trading costs added, so what we do in the next workspace, I've actually added some trading costs, and I'll show you that we've added 6,000 yen, so that's equivalent to 6 pips. I normally add quite that much if it was euro dollar or pound dollar, but because we're dealing with pound yen, the spreads can be a slightly bit larger, so we're allowing for a little bit more. So let's have a look at the equity curve, and you can see that the curve hasn't really changed a lot. Let's have a look at the total trade analysis, and now the average trade's gone down to 39,000, but still a very, very strong average trade, something that's very tradable. And because we're dealing with a strategy that's trading with trades that last multiple days, then the small trading costs of 2, 3, 4, 6 pips doesn't affect the trade that much, because we've got that much more profit in each trade. When we're trading shorter term, so we're day trading, we're only in a trade a matter of hours, then a few pips of trading costs can have a big impact. So that's why spreads and trading costs don't impact trades so much over longer term trades. To conclude then, what we've seen is a strategy using RSI, buying those overbought levels above 70, shorting or selling those oversold levels below 30. We've seen how it works on a 240 minute or 4-hour chart of pound yen looking over those 13 years. Quite consistent behaviour, which is really good. And we've also looked at a few improvements along the way, a few optimizations, and we found a stop loss level that works quite well too. That's it for this video, but look out for some more like this. I know you guys have been finding these strategy type videos really quite helpful, so I'm going to continue to make more of these in the future. But until the next one, this is Jared Goodwin, and thank you.